So I don't think it's an exaggeration to say this is the ETF of the moment. You think about just how much it's in the conversation, and you can see that with the performance. As Eric mentioned, I mean, this was launched just about 2 years ago. And I wonder, did you design this with a particular moment in mind?
Of course not. I mean, nobody knew what was going to happen. The tanker market right now is in the headlines, obviously, but if you go back decades, it's a very important part of the energy infrastructure, right? I mean, you produce oil, you have to consume it, but you have first to transport it. So over decades, shipping, and particularly tankers, have done extremely well during periods of very strong demand or constrained supply, one of the two, right? It's a supply-demand market. Now, BWET started doing very well last year prior to what's happening in the Middle East. I mean, last year was up, I think, 100%. Year to the war was up 200%. So it wasn't really the war that caused the outperformance. Now, obviously, once you have this, and then you throw the biggest geopolitical event of our lifetime, I would say, for oil, then you had, obviously, the last month performance.
So USO is trading a ton, and it's an ETF with baggage, okay? And it's still, every time oil goes up, USO sees all the action. That's futures too.
Yes.
You also tracking futures. Yours are more sensitive to this whole situation, up a ton more. How do you get people aware and interested in it?
Well, obviously, when you have events like that, people understand that tankers are the most levered play in energy, by far, more than the price, the flat price of oil, as they call it. Reason being that transportation cost as a percentage of oil is so small. Like prior to the move in oil, transportation was something like 2 or 3% of the price of oil. Now that has moved to like 8 or 9 or 10%, but still is a small part of oil. So you get extremely high leverage when you have these moves, especially when you have events like that.
And I am curious, you told some of our colleagues over at Bloomberg News that when it comes to that headline fee, 3.5%, certainly very high when it comes to the whole of the ETF industry. But you said that fee could drop if this ETF gathers enough assets. I mean, what sort of range do you have in mind for at which point you would lower that cost?
So that's a very interesting question. I think goes to a lot of futures-based ETFs. First of all, a lot of our assets, or the great majority of our assets, is in cash, because when you buy futures, you have to deposit the cash. So this cash earn interest, and today they earn interest more than 3.5%. So actually, for the investor, your net fee is almost zero, because you get the interest from the futures, and then you have the management fee. Now, the 3.5% is the max management fee. As assets grow, because you have fixed expenses, the actual management fee drops, and actually, you can end up in a situation in a high interest rate environment that the actual investor gets money back if you net the two out.
Let's say people saw this or start getting into it. They start jumping in, just like they did USO a few years ago. Every now and then an ETF gets hot, right, because the performance is so good. Is the underlying futures market liquid enough to handle a lot of incoming? Because it does seem like pretty obscure to me. How much could this grow to with everything being kosher?
So the market is very liquid, especially for the strategy that we have. Keep in mind the 3-month forward futures. I know it's getting very technical, but it's not only one contract. We hold like 6 or 7 contracts we can trade. And we have another ETF that follows dry bulk, and it was the same position that BWET is today. And the liquidity there is in the hundreds of millions. So we don't have an issue like that. Again, that's a good problem to have, obviously, but I think for now, it's not an issue for us.
And I am curious, I mean, when you step back and think about this ETF, who do you think is the natural audience for something like this, for a product like this? So
shipping is a very uncorrelated asset class, right? And if you forget what's happening today in the world of shipping, having a very small part of your portfolio is something that doesn't correlate with other assets, especially headlines, like the Fed, inflation, GDP growth. This is a global diversification for your portfolio. So I think it's something that can produce significant high returns, like you have with BWET now, and you had BDRI a few years back. And it can be a very small part of your portfolio because the returns in shipping are extraordinary.